A few days ago, Indorama Ventures reported its first quarter earnings for the year of 2024. And to join us in the studio today to discuss that result, I'm welcoming our Deputy Group CEO, Mr. DK Agarwal. Welcome once again to you, sir.
Thank you, Stuart.
Let's get straight onto the results, should we? Now, on a quarter-by-quarter basis, actually, we saw quite an improvement, didn't we? But it was still relatively flat year on year. What for you were the key takeouts?
Yeah, I think, 23 has been a year of a lot of destocking. If you see first quarter, our volume growth has been 3% quarter on quarter. Naturally, this has come from destocking coming to an end. We have seen in CPET, the stocks have really ended along the value chain. We are still seeing in Indonesia, some destocking is still happening. So certainly the volumes are coming back, although we got impacted by winter freeze in United States, which will not be there in second quarter. As we speak today, we see second quarter volumes will be stronger than first quarter. The utility cost has been favorable because the energy prices in Europe, because of mild winter, has been better. In United States, the energy prices are quite low, which is certainly helping us in the conversion cost. So it is a gradual recovery. I would say the management action on cost optimization continues. We are also benefiting partly from Red Sea crisis because the import parity, in particularly in Europe, has gone up because of the higher freight as the ships are going through Cape of Good Hope rather than Red Sea. So certainly we see some encouraging signs, but too early to say that we have a V-type recovery. Sequentially, it looks that we'll do better.
Well, I was going to press you a little bit on that a bit further because you seem to be suggesting that it's a recovery in destocking. So is it too early to say it's the beginning of the end for destocking? And what do you think we will be recording from an earnings point of view for the next 2 or 3 quarters to the end of the year?
It is too early to say right now, but certainly second quarter, we see that volumes are coming back, but the industry spreads in China still remains low. Chinese demand is still bad. The reason being that Chinese domestic demand has just started picking up. China has just launched a stimulus package on housing. Hopefully that helps in the overall construction demand. High interest rate is taking a toll on the construction side. So if you see, the construction recovery is still not there. The Chinese is weak. India is a bright spot. US economy is doing good. So there are still some challenges, but I would say this year should be much better going forward.
Just reviewing the quarter again, which was particularly important for Indorama Ventures for another reason, because you'll recall back in early March, we announced to the market at our Capital Markets Day our new IVL 2.0 evolved business strategy. And that was quite a big deal for the next 3 years going forward. Could you please explain just the key tenets of that strategy and what progress have we made in the first couple of months?
Yeah, that's very important. So in Capital Market Day, we came out with a very clear strategy, IVL 2.0. We did a deep dive on our asset portfolio, understanding what are the structural changes happening in the world, how our operating environment should change, the way we should operate. And as a result, we took a lot of strategic dive into our asset portfolio and came out that 6 assets really which are operating at high cost needs fixing because the overall operating rate has been 74%. And as a result, we are doing presently deep dive on those assets because they have been incurring losses, making negative EBITDAs. This cumulatively will translate into $195 million of fixed cost reduction over 25-26 on a per annum basis. We are working, I think in Rotterdam, we are actively engaging with Work Council and what is the right way to approach those assets. So we are on that path. Secondly, our pivot has changed from debt equity to debt over EBITDA. We want to make much stronger, healthy balance sheet. This means we have to deleverage, and deleveraging has few components. Okay, disciplining more on the maintenance capex and growth capex, which we are have put very strong governance on it, disciplining it. The divestment of some non-core assets, we are working on it. Those again, the teams have been formed. On IPOs, there are 2 IPOs which we are targeting. The work is going on those. So we are quite hopeful of our progress as we go down, because remember, this is up to 26. What we are trying to raise is $1 billion from IPO, divestment $300 million, which will basically reduce the debt to 4.3, and our EBITDA improves to 2.1 from 1.3, because 1.3, if you add 100 million of a energy hedge loss, is 1.4 billion. And we are assuming this to be at the trough of the margins. We are not taking that margins may improve, which should logically improve, because Chinese are making cash losses on that. But how, by management action and fixing those assets properly, using the digital tools, making right decision making, how we can improve the quality of earning and go over debt over EBITDA much lower than 3, which makes companies stronger for future growth.
Well, Mr. Agarwal, thank you once again and as ever for that quarterly update. We certainly look forward to the next one in about 3 months from now.
Thank you.
Thank you, everyone, for joining us.
Thank you,
Goodbye.
Stuart.